Good afternoon, viewers. Once again, you are welcome to Sunday Looking at Funny online tutorial. So this afternoon, I want to see the concluding part of the concept and need for assurance, which we have taken two parts previously. In those two parts, we discussed the meaning and objective of audit. We also talk about eligibility to act as an external auditor. We discuss element of assurance engagement. We also talk about uh, duties and rights of an external auditor. So this afternoon, I want to start our lecture from the scope of an audit. That is, when an auditor wants to carry out an audit, what are the activities that will be involved? So an audit involves performing procedures to obtain audit evidence about the amount and disclosures in the financial statement. For instance, if under long-term loan, you see the auditor see 500 million naira, for example, long-term loan under long-term liabilities. So the auditor want to carry out procedures to ascertain the amount of that loan and disclosure made about it in the financial statement. For example, the amount, as you have said, is 500 million naira. The auditor will go and look for disclosures in the notes to the account to know the repayment period of the loan. So how does the auditor substantiate that amount is correct and the disclosures that has been made in the note is also correct? So one of that procedure is that the auditor will request for the written resolution where the company has agreed to go and borrow that loan in the first instance. You may also check minute of directors meeting where the issue about the borrowing of the loan has been discussed. The auditor can also take a further step to write to the bank to confirm whether that loan was actually borrowed by the company, and also check the company bank account whether the money, when it was being disbursed by the bank, actually enter the account of the company. So these are the practical procedures that the auditor will carry out to ascertain that amount, 500 million, and the disclosure that has been disclosed also in the notes to the account. We will know, okay, from the correspondence of the company with the bank, that the bank will be paying the money back maybe in 2 years time, in 5 years time, or in 10 years time. And we also have information about the interest rate that the company will also be paying on the loan. So that is the procedure that the auditor will carry out in that instance. So number 2 here is that the procedures selected depend on the auditor's judgment. Auditor's professional judgment is what will determine the kind of procedure that the auditor will select, including the assessment of the risk of material misstatement of the financial statement, whether due to fraud or error. So the auditor will also assess the risk of material misstatement. He may be able to make that assessment easily by referring to International Standard on Auditing 315. He say identify and assessing the risk of material misstatement through understanding the entity and its environment. The auditor will seek to understand, okay, what is the integrity level of the management? So what kind of accounting system are they using? How effective is their internal control, and so on and so forth. And the risk at the end of the day may be assessed as being high or as being low. So we move from there to The third one, in making those risk assessments, the auditor considers the internal controls that are relevant to the entity's preparation and fair presentation of the financial statement in order to decide audit procedures that are appropriate in the circumstances. That is, in the circumstance of that specific client that is being audited, but not for the purpose of expressing an opinion on the effectiveness of the entity internal control. We will consider internal control in a more elaborate way in our future lecture. Some internal control that management may put in place is that they may include approval of certain amounts that are above a certain limit. They may also include segregation of duties and so on and so forth. So then the last one here is that an audit also include evaluating the appropriateness of the accounting policies used and the reasonableness of accounting estimates used by management, as well as evaluating the overall presentation of the financial statement. So management use various accounting policies. For example, in the depreciation of motor vehicle of the company, for instance, they may decide that they will be using straight line method for that class of asset, and for depreciation of maybe computer equipment, they may decide to use reducing balance method or as they deem fit. But whichever one they agree to use, that will be the company policy, which will be different from one policy from one company to the other. Then the reasonableness of the estimate used by management, as well as evaluating the overall presentation of the management. Management also use estimate. For example, in item like provision for bad debt or provision for warranty. So the auditor will also consider whether those estimates that have been used are reasonable. So from here down, we move to the next stage of our lecture, which is advantages and limitations of external audit. Advantages and limitations of external audit, or we may say advantages and limitations of audit and assurance. So external audit have some benefits which include the following. One is that it increases the credibility of published financial statements. It increases the credibility of published financial statements. Now, when the company prepare their financial statement, the auditor will come around to come and audit it. He will discover some mistake or anomalies and he will ask the company to correct them, and by so doing, credibility would have been added to that financial statement. So even where some companies are exempted from audit, from having their annual audit, maybe due to small company audit exemption, statutory exemptions, the company may on their own request that the auditor should come and an external auditor should come and audit their financial statement, because by auditing their financial statement, credibility will have been added to it, and they may want to use it maybe to convince creditors or banks so that they can borrow them money. So those bank or other creditor will value and place greater premium and reliance on the audited version of the financial statement. So that is that about that. Then second one is that it confirms to management that they have performed their statutory duties correctly. So that is number two. It confirms to management that they have performed their statutory duty correctly. So management have certain responsibility or duties to perform. One of them is that of the preparation and presentation of financial statement. Another one is design and implementation of effective system of system of internal control in order to avoid or prevent fraud and error that may lead to material misstatements in the financial statement. And it is also the duty of the management to assess the going concern status of the company. So after an audit has been carried out, it will confirm to the management that they have performed all those statutory duties correctly. So the third one is that it provides assurance to management that they have complied with non-statutory non-statutory requirement such as corporate social responsibility report where such requirement corporate social responsibility requirement where such requirement is subject to audit or review. So then the next one is that it provides feedback on the effectiveness of internal controls of the client. Where internal control is weak or inadequate, the auditor makes recommendation. Recommendation for the improvement this help the management to reduce risk and improve their operations, improve their performance. So that is that about the advantages of external audit. So we now move to limitation. Limitations of external audit. Number one, its cost. So the cost of external audit can be very high. However, where the auditors have been engaged to perform some non-audit work such as account preparation and advisory work, the cost of audit may be fairly small. So So number 2 here is disruptions. Number 2, disruption on the work of client staff. Some client staff may be required to assist the auditor by answering questions providing documents and other information. Then number 3, some items in the financial statement are estimates whose truth and fairness can only be ascertained in future. This means that the assurance opinion is subjective and judgmental. Another one is that no matter how robust an entity system may be, they will usually incorporate some inherent limitation. And lastly, audit evidence are persuasive rather than All these evidence are persuasive rather than being definite or conclusive. So that is that about limitation of external audit. So the last thing we shall be looking at is assurance on internal controls. Assurance on internal controls. Assurance on internal controls. So assurance on internal controls. So among the many responsibilities that management of the company have to carry out is to assess the business risk that is facing the company and design and implement appropriate internal control in order to mitigate those risks. So assurance provider or auditors, as you may want to call them, assist management in carry out those responsibility by preparing and submitting two type of report which are known as type 1 and type 2 report, or type 1 or type 2 report. So I'll be starting my explanation from type 1 report, which comprise type 1 report comprises 1 or A, as we want to call it, a description of the service organization system, its control objectives, and the controls at a specified date. This is prepared by management of the service organization. Then number B, an assurance report on the above description and how the controls achieve their objectives. Prepare by the auditor instructed by the service organization. So what is that about? Type 1 reports, then type 2 report which is more detailed than the theoretical control in place, but also address how the controls achieve their objectives in practice. the report may cover a specified period and also describe the effectiveness of the controls within the period cover. Full stop. So thank you very much for your time. Before I round up the lecture, I also want to call your attention to the fact that if you are joining the lecture newly, kindly subscribe to the channel, like it, and also share it with the other. And should you want to contact me, I will briefly write my contact on the board through which you can actually contact me. Thank you very much for your time. See you in our next video.